even just the fact that they say you can never lose money is a misrepresentation of the facts.
It's actually a lie.
Correct.
And could you maybe explain why that cap is more harmful than it seems? Because they might say, well, the market averages, 9.5%, 10%. So if it's a 10% cap, that's not so bad, right? Can you explain why that's a fallacy?
Yeah, because many of the years in the market returns significantly more than 12%.
Right.
And if I'm not participating in that, that's a big deal, right? Like, as an example, if we just go 2021, the market, the S&P 500 index returned almost 27%. If my cap is 10%, I just missed out on 17% growth. 2020, the market returned 16.26%. If my cap is 10, I just missed out on 6%. In 2019, the market returned almost 29%, right? If I'm not participating in the real upside of the market, that is incredibly costly. Even if I have a floor, right, and it seems so appealing to have a floor on the returns that you can get, even in years that are really bad, like 2008, market's down almost 40%. If my floor is 0, I feel pretty good about that. But the problem with that is, if I'm an educated investor and I'm dollar cost averaging into my investments, the most exciting times are when markets are down, because I'm able to purchase more assets at a discount during those times. Whereas in a life insurance product, I don't actually own really any true assets.
It's just tied to that index, or it's tied to that investment performance.
It's tied to it. It's not actually in it.
Yeah,
if it was in it, it would participate in the full upside and the full downside. It's not actually in it.
Well, as an example, over the last 50 years, out of the last 50 years, 32 years, the S&P 500 has grown by more than 10% per year. 32 years out of 50 years has been more than 10%. So 64, 65% of the time, it's higher than 10%, right? That becomes important to know. Right?
So just on the average year, you're already losing money from that cap.
Yeah.
Just on average, let alone the years like you were saying, where it's like close to that 30% mark. Then you're just losing so much wealth there. And not only are they robbing you with the cap, they're also robbing you by stealing the opportunity to invest in the downside, right? So it's a double whammy.
Yeah, exactly.
Yeah, well, and the other thing is that, like, dollar cost averaging for the long-term investor becomes a very powerful tool.
It's maybe the most powerful tool that someone could have.
Right.
Because nobody can time the market, right? You and I don't know when the market's gonna be up or down, but if we're dollar cost averaging, we know that we're gonna be taking advantage of those.
And so if you think that the zero floor is a benefit, it's actually hurting you in the long term. Correct. Because you never, even though the market went below zero and say it dropped 5 or 10 or 15%, you couldn't participate in buying equities at a lower price because your insurance policy specifically prevented you from doing so.